Hi, this is Todd Baker, your certified mortgage planner. And today we're going to discuss how to read and understand a loan estimate for an FHA loan. So, what a loan estimate is it's part of the initial loan disclosures that are required to be sent when certain information has been obtained by a lender. And on a purchase, it's usually you have a pre-qualification, then it's usually once you actually find a house and now there's an address. That requires an initial disclosure. So it's different. The loan estimate's different than what you get during the pre-qualification. What you get during pre-qualification is some sort of presentation. Most loan officers send just a spreadsheet or a fees worksheet that shows everything listed. Most loan officers, most of you, if you've gotten one of these before from someone else, they come usually with very little explanation other than here's what you have to bring to the table and here's your payment. What I do as a certified mortgage planner is a complete mortgage plan that'll amortize cost over time to make sure you're getting the exact right mortgage for your current situation in 5-year to 7-year horizon. So it's a little bit different than what I do. It's much more thorough. But the loan estimates, the nuts and bolts of what your loan is once you find a house. So the pre-qual is just an estimate. Now you've got a loan estimate based on a house. So let's go over how to read an FHA loan estimate together. So first off, you can see where it says loan estimate. You can see the sales price of $375. You can see the 30-year term. It's a purchase. It's a fixed rate. You can see the box FHA checked. And right here on the rate lock, that's really important because I get loan estimates sometimes from borrowers and it'll say rate lock no. That means that the interest rate's floating. So if rates worsen, then your interest rate will worsen. If they improve, then they could take advantage of a little bit lower rate. But it's really playing the market. So you want to make sure you get your rate locked just so you don't have to worry about, a chance, 50-50 chance that it can actually get worse. Next, you have your loan amount. Now, the FHA, typically the minimum down payment's 3.5%, but then the FHA has a funding fee that gets added to the loan amount in finance. Like this loan amount is closer to 98% of the 375 because it includes the funding fee. So you'll have a loan amount, the interest rate, and then you'll have the principal and interest payment. Then down here on an FHA loan, you're going to have a mortgage insurance premium. So let me stop here real quick and explain mortgage insurance. So mortgage insurance on an FHA loan, there's an upfront one that gets financed, I just mentioned. Then there's a monthly one. And the advantage of FHA, it's the same one regardless of credit score. At 3.5% down, it's 0.85% of the loan amount, and then you divide that by 12. It's done automatically, so in this amount, it was like $200 and some odd dollars. We'll go back over that in a minute. But on a conventional loan, so if somebody says, oh, you can do a conventional loan because FHA mortgage insurance lasts for the life of the loan. That's true. Whereas on a conventional, it eventually cancels. But it takes typically 11 years to cancel on a conventional loan. And if your score is below 700, it's higher, and the lower your score goes, the way conventional works, the lower your score goes, there's like buckets like 680 to 700, 660 to 680, 640 to 660, and the lower you go in those buckets down to 624, the higher. I mean, you could literally pay double for mortgage insurance on a conventional loan, and most people are only going to live in a house 7 years. So you really need to be working with somebody that knows what they're doing, that isn't just going to try to sell you on what they think you want to hear, but it actually has the confidence to give you a transparent, good feedback. All right, so that's good feedback I'm giving. FHA is a great loan program depending on your credit score. So that's that monthly insurance premium. Then you have your estimated escrow. It's $812. You can see down here it says $812 because it includes your property taxes and insurance. And other would be HOA. In this particular example, there's no HOA. So you get your total payment of $29.59 on this example. Next, you see costs at closing. So this estimated cash to close, $21,319. That is in this case is what the client is bringing to the table. That's their all-in. That includes their down payment and their cash to close. Right here, this estimated closing cost. This number always scares people because if you look, it says $15,000 in closing costs. Well, that seems extraordinarily high. But that's because those numbers include the FHA funding fee, which gets financed. So that's a real large fee that's making that number seem huge, but you're not paying that out of pocket. That's number one. And number two, it also includes all the stuff the seller is going to pay for. So don't get worried about that particular number. You want to get into the details to make sure you understand. You also have your prepaids right here. So let's look at page 2. So page 2 is going to list A, B, C, D through J, all the closings. So typically the first one's going to be your loan charges, right? So you're going to have some discount points, or maybe you don't have any discount points. Our lender fees are always $695 and $695. That's it. Lender fees tend to be about the same no matter where you go. They're called different things, but they're all around $1,200 to $1,400. That's not a reason to shop for a mortgage, because they're all going to be about the same. And by the way, quick note, interest rates are all going to be about the same. They're primarily driven by the market and your credit score. We all get our money from the same spot. So the end rate tends to be about the same, not a big difference in rate between lenders. So what you do when you're shopping for a loan officer is someone that really is going to give you great advice and structure your loan correctly, teach you how to pay it down faster. That's where you make your money. Next is services you cannot shop for. So you're going to have an appraisal, credit report fee, the doc prep, and then see right here, this is that funding fee I talked about. $63.88 or $63.33. That's part of the 15 grand. That's not really a closing, right? Then you've got, it is a closing, but it's getting financed. And I'll show you right here. See, down below, which we'll go over in a minute, you have all your credits. But this, like I said, this is going to get financed. So this is already in the loan amount. Next, you've got all your title services. It says services you can shop for, but the title isn't really shopped for except for when you're negotiating a contract. If you look on your contract, on page 1 and going into page 2, it has all the title services, and it's whatever the party selected as a title company is what ends up getting used. So a survey is negotiable who pays that. On a new build, you always need one. On an existing home, sometimes the seller has a survey that can be used, and then that doesn't have to be charged. If not, then it just depends on how you negotiate who pays for it. The escrow fee is the fee that covers is paid to the title company that's split. So it's usually like about $850. In this case, it was $850 split in two, seller and buyer, $425 to the buyer, and that's to handle the paperwork. Then there's some miscellaneous charges. Then you have your title insurance and all your endorsements. Your title insurance actually insures free and clear title to you, and it's normally paid for by the seller. I'll show you that in a minute. So of that 15 grand up top that was looked like a big scary number, already we have almost $9,000 that one getting financed and another one getting paid by the seller that you don't have to pay, right? Then you got a deed recording. That's just to record your deed with the government. Then you have prepaid. So when you buy a house, you're always going to prepay your insurance up front for a year. So in this case, it's assumed $125 a month. So $125 times 12 is $1,500. Then you're also going to prepay interest. It's basically it goes by the day you're going to close to the end of that month. So let's say you were closing March 25th. You have 6 days of interest, and then your first payment skips a month. It would start in May. So this prepaid interest is just going to be, if you're earlier in the month, that'll be higher. This assumes middle of the month at 15 days. Okay, so that goes up and down based on the closing date. Then you have your escrow. So here's an easy way to understand escrows is this. Under federal law, you have to have 3 months of reserves for insurance and 3 months of reserves for property taxes. So right out of the gate, there's always 3 months for insurance because you've already paid your insurance in full for a year. For property taxes, they're due in December. So you start with 3 for the reserves, and then you count how many months go up. So if you look at this was closing in 5 months. So that was a closing in February. So it's 3 months for reserves and then 1 month for January and February. And the idea is by the end of the year, there'll be 12 months in there plus a cushion of 3 months for reserves so that so us as your loan servicer pay your taxes. And then down here you have the rest of the credits. You get credits for your earnest money deposit and the seller credits for the tax proration and title policy. So there you have it. That's how you read a loan estimate for an FHA loan. Hope you find this helpful. And if you would like to get the kind of advice and service I provide, reach out to me. We'll take great care of you.